Okay, so we're doing chapter 20 tonight, the last one of the semester. All right. I would say that on your final, this is the second hardest chapter after chapter 18 because it requires a lot of knowledge about the theory to be able to do the problems. Once you know the theory, I think you're good to go. Yeah. So we'll start. A lease is an agreement between two parties, which is a lessor and a lessee. The lessor is the ones that's going to be renting their asset, and the lessee is the one that's going to get the asset and make annual payments to the lessor for the use of the asset. So for a specific period of time, the lessee has the right to use the asset owned by the lessor. And yeah, that's basically what a lease is. You can think about when you're leasing skis for the winter season. So you go to a store, you say, hey, I want to rent skis for the winter months. I'm going to be making monthly payments. And in March now, when there's no more snow, I'm going to give them back to you. So that's a type of lease. There's two types of leases. There's a finance capital lease or an operating lease. Finance capital means that the lessee is going to record an asset and the lessor is going to, it's basically capitalized versus expensed. So for the capital and finance lease, it's basically a lease that transfers substantially all of the benefits and risks of the property ownership should be capitalized. And then an operating lease is when the benefits and risk of ownership aren't transferred from one party to the other. You need to determine if it's a capital or operating lease for both the lessee and the lessor, because sometimes the lessee, it could be a capital lease for them, but for the lessor, it might be an operating lease. So you have to do the analysis for both of them. And that's where the theory part comes in. After that, you're just doing the transaction based on if it's a capital or operating lease. So there's criteria to determine if capital finance. So for the lessee under IFRS, there's 4 criteria, but most of the time they're always fulfilled. And most of the time that means that it's a capital lease, finance lease. So everything is capitalized. If either the lease is short-term, so for under a year, or the payment that the lessee is making to the lessor is less than $5,000, then the lease is going to be capitalized for the lessee. And if none of these two are fit, then it's going to be a capital lease for the lessee. Also, they can elect for it to be a capital lease, if I'm not mistaken. And then for ASPE, it needs to fulfill one of the following criteria. So does the lessee has a bargain purchase option at the end, or do they keep ownership at the end of the term? A BPO is a provision that allows the lessee to purchase the lease asset at a specific point in time at a value that is less than the expected fair market value of that asset at that time. At the beginning of the lease term, you have to be reasonably sure that the difference between the fair market value and the PPO is big enough that for sure the lessee is going to use their bargain purchase option. Then after that is the lease term at least 75% of the useful life? So if your lease term is 4 years and the useful life of the asset is 8 years, that means that is 50%, and that criteria is not fulfilled. And is the present value of the minimum lease payment is at least 90% of the fair value of the asset. So if the sum of all the lease payments that the lessee is going to make to the lessor throughout the lease term, you take the present value of that, And if that is at least 90% of the fair value of the asset at the beginning of the lease, then that fits, then that criteria is fulfilled. So you need one of the three for it to be a capital lease. If there's none of them that are fulfilled, then it's going to be an operating lease.
Sorry, just a question.
Yeah.
For IFRS as well, it's only one of the criteria that needs to be fulfilled for to be a capital lease.
Yeah, basically there's 4 criteria in your notes, but they're most of the time always fulfilled. So I can write them down too. I have them in my notes. I didn't put them here because you might get asked in the exam to put them, but they're always going to be fulfilled. So it's, whoops.
But like the ones that you posted, like for
These
those
two?
two, yeah, it's one of the 2 that have to be fulfilled for it to be a capital lease. Like, I mean, that
It to
it's
be an operating lease. So
okay. So if it's greater than 1 year, and if it's greater than $5,000, if it's one of the 2 cases, then it's a capital lease.
reverse. If it's less than 1 year, and if it's less than $5,000, it's an operating lease. And if it's more than 1 year and more than $5,000, it's a capital lease.
Okay.
So most of the time it's going to be capital, because it's rare that you're going to see like a lease of 1 year and a minimum payment of $5,000, because it's really
Okay. Okay. Thank you.
no problem. But just, I'm going to put them there, and you're going to see it when I post it on the Facebook. But there's also the transfer of ownership, economic life, and recovery of investment by lessor, and it's one of the 3, but they're always fulfilled. I don't think they're going to try and trick you and not use one of those 3. It's most likely going to be one of those 2 that you're going to see on your exam. All right, just switch this back here. All right. So ask you, we did that, and then to calculate the present value of the minimum lease payment, you're gonna do a present value calculation. So your N is going to be how long the lease is for. Your future value could be 0. If you have a BPO, then your future value is your BPO. Or if you have a guaranteed residual value or unguaranteed residual value, that shouldn't be here. Hold on, I thought I corrected it. All right, sorry about that. So yeah, if you have a BPO, a guaranteed residual value or unguaranteed residual value, then your future value is going to be these amounts. And if you have none of the 3, then your future value is 0. So we talked about the BPO. A residual value is the assets estimated fair value at the end of the lease term. And when they say it's guaranteed, it means that it's the maximum amount that the lessor can require the lessee to pay at the end of the lease. And unguaranteed is portion of the residual value that isn't guaranteed by the lessee. So you don't really need to know what they are, because they don't really affect much of your calculations except for the future value here. But just know that there's a guaranteed and unguaranteed residual value. And then your rate that you're going to use you're going to see 2 rates. You're going to see a internal rate of return with implicit rate of in lease, IRL. So that's the lesser rate. And then you're also going to see an incremental borrowing rate, and that's the lessee rate. Under ASPE, you're going to take the lower of the 2. And under IFRS, if the lessee doesn't know, if the lessee knows what the lessor's rate is, they're going to use that. And if they don't, they're going to use their own. For the payment, it's often given, and you need to remove any executory cost from the payment. So if they mention that the annual payment of the lessee is $50,000 and that includes $5,000 of executory cost, then your payment here would be $45,000. Sometimes when this is not given, you're gonna have to put your present value as the fair market value of the asset. But if it is given, then you're gonna find your PV with all the information that you put above. We're gonna see, I think both example, we're not giving the payments amount, so you're gonna see how that goes. For the lesser, for IFRS, it's exact same criteria as what we saw earlier for the lessee. So short-term leases and less than 5,000 minimum lease payment. And for ASP, it's the same as the lessee, plus they need to fulfill the two following criteria to put it as a capital lease. So they need to be resident, they need to know that they're gonna have reasonable payments from their lessee. So basically what that means is that they know that their lessee is gonna pay, that they have sufficient resources to pay. And also that there's no uncertainties regarding future costs to be incurred. So that's the executory cost. So they know how much in the future they're gonna have to pay in costs in regards to this lease that they're entering into. And then if it is a capital lease for the lesser, it could also be, well, no, it's a capital lease first, and then there's two types of capital leases. There's a sales type and the direct financing lease. So the sales type is if the cost base for the leased out asset is lower than its fair market value. There will be a profit made on the inception of the capital lease and recognize cost of goods sold and inventory reduction. So if your book value and your fair market value of the asset that is being leased out is different, you're gonna have a sales type lease, but that's only if it's a capital lease. And when you're gonna record your lease, you're gonna have to record a sale of the asset. So you're gonna enter your cost of goods sold, a reduction of inventory, and a sale account. And you're also gonna have an interest income, which is the same as with the direct financing lease. So here, instead of having the sales and COGS and everything, they don't recognize that. They're only gonna recognize the interest income on the payment amount from the lessee. So basically the interest is going to be a gross investment in the lease or a lease receivable account. And that amount is going to be the total of the minimum lease payment, so all the payments throughout the years, minus the executory costs, and any unguaranteed residual value, guaranteed residual value, or BPO undiscounted. And your unearned finance income is the difference between the undiscounted lease receivable amount and the fair value of the lease property. And then you're going to have the net investment in lease. That is going to be the net of the two. And that's it for the theory. I didn't put the journal entries because we're going to see them in the problems. So it was a quick one today. All right, so I'll jump right in. What did I put? I'm just trying to get everything set up. All right, doesn't want to open. That's great. All right, okay, got there. Okay, so for the first question, on January 1st, 2008, Canadair Jets Inc. enters into a 4-year non-cancelable lease agreement to lease a regional jet plane to Canada Airlines, with payments required at the end of each year. The following information relates to this agreement. The airplane cost Canadair Jets $7.6 million. On the date of the lease, it has an estimated fair market value of $20 million and a useful life of 5 years with zero residual value at the end of that time due to technological obsolescence. Executory cost of $132,000 annually related to the leased plane will be initially paid by Canadair Jets and collected from Canuck Airlines. Annual year-end lease payments that will allow Canadair Jets to earn an 8% return on its investment. When the plane will revert to Canadair Jets at the end of the 4-year period, it's estimated to carry a fair market value of $4 million, though there is no guarantee from Canuck regarding this value. IFRS applies to Canadair Jets and ASPE to Canuck Airlines. Both companies have a December 31st year ending, and you may round all computed amounts. So we'll do one section at a time because there's a few sections. So for section A, they're asking us to do this section regarding Canadair Jets only. So all the questions we're going to look at is only for Canadair Jets. First, before we start, I want to point out who's the lessor and who's the lessee. Make it easier. The lessor is Canadair Jets Inc. They're the one that are leasing the plane to Canuck Airlines. And they use IFRS. For the lessee, it's Canuck Airlines, and they use ASPE. All right, so for 1, indicate the type of lease Canadair Jets has entered into. Support your conclusion by applying the appropriate criteria for the classification. Clearly state the criteria specified under IFRS and indicate which criteria applies. So first, we're going to look for the short-term lease. So is it smaller than 1 year? So here, if they say that the lease is for 4 years, so it's bigger. So that means that it's going to be a capital lease. And then 2 is the minimum lease payment smaller than $5,000. They don't tell us what the payment is, right? They didn't tell us annually how much they're paying. They just told us that there's executory cost of $132,000, but they didn't say the payment regarding the lease. So that means that we're going to have to find it out. We're going to have to compute it. So our lease term is 4 years. The rate is 8%. Just want to check. Yeah, 8%. The future value is the unguaranteed value of $4 million. Your payment, this is what we're going to find, and then your present value. Since they did not specify what the payment is, you're going to put your present value as the fair market value of the asset, which is $20 million in this example. So then you can find your payment. So your rate here, PV, FV, and then they say when do they pay it? Payments required at the end of each year. So it's the end of the year. You have to be careful when doing problems. Sometimes they pay it on the beginning of the year, sometimes at the end of the year. So that's going to affect your calculation. So the minimum lease payment is $5 million, which is definitely greater than $5,000. So that means also that it's a capital. So it's going to be a capital lease. And then is it a sales type or direct finance type? We're going to see the book value of the asset, the fair market, and if there's a difference between the two, then it's going to be a sales type. So the book value is 17.6 million. And the fair market value is 20 million. So if they sell it, they have a profit of 2.4 million.
I have a question.
Yeah.
If it's not a sales type, is it automatically the direct?
Yeah.
Okay,
for capital leases only.
okay,
Basically, sales types just adds accounts on your first transaction on the lease.
okay,
And it's only for the lesser two. Lessee, it's capital lease or financing lease. Sorry, capital or operating lease. All right, so that's done for requirement 1. For requirement 2, determine the total annual installments which Canadair Jet seeks to receive from the lease contract. So we already calculated the minimum lease payment, which is the $5,150,000 that we found here. This doesn't include your executory costs. That's very important, by the way. When you're calculating this here, do not include the executory costs in your payment amount. Here we're going to add them because they ask for the total annual installment and not the minimum lease payment. So when the lessee, when Canuck Airlines is going to make their payments yearly, they're going to have the minimum lease payments for the lease, and they're also going to pay back the executory costs amount. So they make the payment at the same time for both of them. So that's why we're adding it. So executory costs are $132,000. So that means that the annual installments is going to be $5,282,000. Want to check? So the same thing. Yeah. All right. So for the third requirement, prepare the lease-related journal entries on the accounting books of the lessor on January 1st, 2008 and December 31st, 2009. I'm going to start with January 1st, 2008. So this is the date that the lease, they entered into the lease agreement. So the transaction is they're going to first recognize their lease. Well, this is the GIL for the lease payment receivable. So this is the full amount of payments that they're going to receive from the lessee. So you want to do the lease term times the minimum lease payment plus any unguaranteed residual value plus the $4 million that's in the problem here. We're adding it because when we're going to calculate our interest revenue, this is going to be a part of it. And also at the end of the lease, the lessee has to pay the $4 million. Yeah. Then you have the cost of goods sold, which is going to be the book value of the asset, which is $17.6 million. And then your sales is going to be the $20 million, so the fair market value of the asset. Just want to add the 0 here. All right, your inventory is the same as your COGS. And then you're going to have your unearned interest income, which is basically the difference between the two, or you can use your lease payment receivable minus the fair market value of your assets. So it's $4.6 million. Another calculation that you might see in the textbook for the COGS and sales and inventory is that they subtract from this amount the present value of the residual value. So the $4 million, they're going to find the present value of that amount. So the rate was 8% for no payment minus $4 million. Then end of period. So basically here your costs would have been 17.6 minus this, and then your 20 million here would have been 20 million minus the 2.9. So could have been these amounts too, but both are right. Just so you know, there's two ways of calculating it. Doesn't mean that one is right and one is wrong. There's just two ways. So that's it for the January 1st, 2008. If it was a direct financing lease instead of sales type, you wouldn't have these here. And you have your, and then you would have here your leased asset, I think. Let me just check. Yeah, you would have leased equipment here on the credit side. Be sure, because it sounds right, but I'm not 100%. Yeah. Leased equipment here. So you're reducing your asset. All right, and then for December 31st, 2009, they're gonna have to recognize their interest income. Oh, I'm not checking the right question. Yeah. So they're going to receive some cash, which is the minimum lease payment. Always the same, plus your executory costs. Don't forget about it. And then they're also going to reduce their lease payment receivable, which is your MLP. And then you have your executory costs of 132,000. Then you also have to recognize your interest income. So unearned interest income and interest income. To find this amount, we're going to do a little amortization schedule, a little throwback from before the midterm. So you're going to have your Jan 1st, 2008, December 31st, 2008, and then December 31st, 2009. You have your MLP, you have your interest, which is 8%, and you have your reduction, and you have the book value of lease obligation. So your MLP is still the 5.1 million. And it's going to be the same amount for all the years. Your interest, you're going to calculate it after 1 year. So you're not going to calculate it for the January. Oh, wait. Your book value of the lease. Wait. I didn't do that. Right. First, on January 1st, 2008, you have your book value of the lease obligation, which is your 24 million. Book value beyond lease obligation. Yeah, it's the 24 million. No, it's 20 million. Sorry. My solution like all disappeared on me. Then on December 31st, 2008, you're going to find your interest amount that they're going to pay you. So it's 8% times your book value of the lease obligation. And then your reduction is going to be your MLP minus your interest. And it's going to give you a book value of the lease obligation of 16 million. Then you do the same calculation for your December 31st, 2009. So your interest income is going to be 1.3 million. And then here on your, hold on, let me just check because my book value here doesn't seem right. I just want to review something. Just make sure I'm not saying anything wrong. This is 2010. Okay, I was right. I'm doubting myself for no reason. Okay. So yeah, your book value of your lease obligation, basically this is the lease obligation of the lessee. You're gonna have to so you always put here your fair market value of the asset, and then you calculate your interest on that amount. So for December 31st, 2008, the lessor is gonna have an interest income of $1.3 million. Then they ask you for requirement 4 to assume that the fair market value of the plane returned by Canuck Airlines on December 31st, 2011 is 2.45 million. Prepare the journal entry to record the transaction for receiving their return aircraft. So basically what's happening here, they're receiving the asset for 2.45 million. Their lease payment receivable. So at the end of the 4 years here, they should have a book value balance of $4 million. So it's equal to their unguaranteed residual value, or guaranteed residual value if it's guaranteed, or a BPO if there's a BPO. And then that means that they have a loss rate. So the asset has a smaller fair market value than the lease payment receivable. So that's going to be a loss on lease of $1.55 million. All right, so that's it for section A. For section B, this is for Canuck Airlines. So if you remember, this is the lessee and they use ASCII. So indicate the type of lease Canuck Airlines has entered into. Support your conclusion by applying the appropriate criteria for classification. So there's 3 criteria under ASCII for the lessee. First, do they have a BPO, or they keep ownership at the end of the lease? I didn't mention anything about that. I don't think they did. There's no BPO, and they don't keep it at the end. So this is a no. 2, is the lease term more than 75% of the life of the asset? So the lease term is 4 years. Says that the useful life of 5 years for the asset. So 4 divided by 5, that gives us 80%. So that means that yes, this works. It's going to be a capital lease. We're still going to check the third one for fun and so you know. So one is the PV of the MLP at least 90% of the fair market value of the asset. We calculated earlier, we saw that our PV was 100%. So this works too. So you have 2 out of 3 criteria. So for sure it's a capital lease for the lessee. Determine the total annual installment which Canadair Jets, wrong section. Canuck Airlines is unaware of the interest rate used by Canadair Jets to establish the minimum lease installments. Determine the amount for which the lease will be recorded. Canuck Airlines has been paying an interest rate of 10% per annum for its operating loans. So since they don't know what's the rate of the lessor, they're going to use their own rate. So for 2, section B, we're going to do the same calculation as earlier. So we're gonna your N is 4, your payment, oh my god, your payment is the same because in the contract they're going to say that the minimum lease payment is 150,000. So your minimum lease payment doesn't change. Oh my god, I'm on my caffeine high right now. Sorry, I'm kind of misspeaking. your future value for them is going to be 0 because it's unguaranteed. So it's not guaranteed that they're going to have to pay anything. And then the PV is what we're going to find, and then your rate is 10%. So rates, payment, your FV, and then 0 end of period. So that gives us a PV of 16 million. So that's what they're going to record in their books on January 1st, 2008. And we're going to see how that goes. Because next they ask us for the transaction for January 1st, 2008 and December 31st, 2008. So for the lessee, it's pretty simple. You put leased asset and lease obligation, and it's your PV amount here. And then this is for Jan 1st, 2008. Then for December 31st, 2009, you're going to have, well, what they're going to do, they're going to have an interest expense. They're going to have a lease obligation. They're going to have the payment of the executory costs. And they're also going to have a depreciation expense because the asset is capitalized. So a lot of number to remember. We're going to first do the transaction that's linked with their annual payment, and then we're going to do the depreciation expense, but it doesn't matter the order. You have your interest expense, you have your lease obligation, you have your executory costs, and you have your cash. This we know already is 132. And to find the difference between the interest expense and lease obligation, we have to do the table again. So January 1st, 2008, and well, your MLP interest. Now it's 10% deduction, and your book value of your lease obligation. So your book value here is 16 million. Your December 31st, 2008, and December. Your MLP doesn't change from earlier. It's your 5.15 million. And then you're going to calculate your interest. So 10% of your book value of the previous period, reduction, and then your book value, and then same thing here. So that means they have a interest expense. What did I do? Well, I'm just going to continue for 4 years, see if I get to 0. I don't know what happened. My solution seems to be lacking. All right, okay, that works. So your interest expense for December 31st, 2009 is the 1.28 million that we found in the interest column. And your lease obligation is basically your reduction. So it's your 3.86 million. Your executory cost of the 132,000. Then your cash is the sum of all of this. So see, it should equal what we found earlier for their annual payments. So 5.282, 5.282, that works. All right, we're now at section C. Use the data given above in the common data section in section C. Also assume for this section only that the residual value for the return aircraft was guaranteed by Canuck Airlines. Assume that the interest rates used by Canada Jet and by Canuck Airlines are 8% and 10% respectively. So first, we're going to find what's the minimum lease payment. So your minimum lease payment is not going to change. So it's still going to be your 5.15 amount here, because what we did here when we calculated it earlier, in our future value, we put our unguaranteed value, right? So it's not going to change whether it's guaranteed or unguaranteed because the amount hasn't changed. And then determine the amounts at which the lease will be recorded on January 1st, 2008 by Canada Airlines. So they're going to have their present value of the MLP, which is the same as what we found earlier, the 16.32 million. But they're also going to add to that their PV of the guaranteed residual value, which wasn't there earlier. So the PV of the 4 million, which is at 10%, right? Yeah. 4, payment 0, 4 million, end of period. So that means that their lease obligation will be of 19 million. Yeah, 19,059,000. And that's it for question 1. So what might happen during your final is you might have one multiple choice for this, one multiple choice for this. So it might be broken up into smaller sections. For question 2, Bridge Equip Limited, Bell, the lessor, agreed to lease a heavy-duty scraper on January 1st, 2015 to Montreal Engineers Limited, Mel, the lessee. Both companies use ASPE and both agreed to the terms stated below. The scraper had a 9-year life with a cost of $846,000 and a fair market value of $1,020,000. It will be leased for 7 years, after which the equipment will revert to the lessor. Bell had insisted that the residual value of $160,000 be guaranteed by Mel, and it was so done. Mel amortizes all equipment on a straight line basis. The annual installments will commence January 1st, 2015. Both companies have a December 31st year end. Bell is normally in the business of selling equipment outright to its customers. However, Mel was unable to get the required financing from its bankers. As Mel was a regular long-term customer, Bell decided to enter into this one-time special transaction. Although Mel has agreed to pay all executory costs directly to the connected parties, Bell was yet not sure about what additional costs it might incur in connection with this lease. It was particularly uncertain about legal costs and recovery of the equipment in the event of Mel going bankrupt. And finally, given the deteriorating financial condition of the lessee, Bell used a discount rate of 15%, which was considerably higher than normal rates applicable to such transactions. The lessee was aware of this rate and had agreed to it since it approximates its current incremental borrowing rate. So question 1, discuss how this lease will be classified by each party. Be sure to indicate very clearly what classification applies to each company. Support your answer by identifying and stating the appropriate criteria for such classification. So we're going to start with the lessee, we're going to start with the lessor. So we're going to start with Bell. So they both use ASPE. So there's criteria under ASPE, but there's also the 2 other criteria for the lessor, right? There's are they certain that they're going to receive the payments from the lessee? And do they know their future costs to be incurred? Now, we're going to look at them first, because if these 2 are not fulfilled, we don't care about the other 3. Because if these 2 are not fulfilled, it's going to be a operating lease. So first, is there reasonably predictable payments? So here in the text, it says that Mel was unable to get the required financing from its bankers. So that means that one, they're not in a good borrowing situation, and two, they don't have the money to buy the asset right now. So Bell is not certain that they're going to receive the payments from Mel. So this is a no. This doesn't work. Financing. And two, is there no uncertainties regarding future costs to be incurred? It said that there weren't Bell wasn't yet sure about what additional costs it might incur in connection with this lease. So this same no. So they're both not working. So this is going to be an operating lease. Even if this one was yes and this one was no, it would have been an operating lease. So that means that we're going to expense it / revenue / lease revenue. And then for Mel, the lessee, we're going to check the 3 criteria. So first is the lease term at least 75% of the useful life. So the lease term is of 7 years. And the life of the asset is am I blind? I think it was 9. I can't see it right now. Oh, Scraper had a 9-year life. So that means that it's more than 75%. So this works. So it's going to be an operating lease, but we can check the other one for fun. Is there a DPO or they keep ownership at the end? No, there was no mention. And 3 is a PV of the MLP at least 90% of the fair market value. Here again, they don't give us the payment that they're going to pay every year, so we're going to have to find it. So that means that the PV is going to be equal to the fair market value in our calculation. So it's 100%. Just visually what it's going to look like. Your N is 7. Your rate is 15%. Your future value is your guaranteed amount of 160,000. Your PV is the fair market value, which is 1,020,000. And your payments that we're going to find. And then here, is it at the beginning of or the end of the period that they make their payments? Due to, I don't know, both communities agrees to state bills. The annual installments would commence on January 1st, 2015. So that means that they make their payments at the beginning of the year. So here, when you're going to calculate your payments, you have to make sure that if you're using Excel, you use beginning of the period, or if you use your financial calculator, you switch it to beginning of the period. And then with the tables, same thing. So here I'm putting 1. So that gives me a payment, annual payment of 200,617. But basically what we were going to look at here is the PV. Is it at least 90% of the fair market value? Yeah, it's the same. So it's 100%. So this is yes. So it is a capital lease for the lessee. Then they ask us, determine the amount of the annual installments which Bell as set for the lease. We found it here. So our minimum lease payment is of 200,617, and executory cost is 0. They're supposed to pay it, but they don't know how much. So your annual lease payments are of the 2,617. For 3, prepare the lease-related journal entries on January 1st, 2015 in the accounting books of the lessor and the lessee. So we're gonna do first the lessor as operating lease. That means that they're gonna receive cash, the minimum lease payment, yeah. And then they're gonna credit their unearned lease rental revenue. At the end of the year, on December 31st, what they're gonna do is they're gonna debit their unearned lease revenue and then credit their lease rental revenue. So cash is the MLP, and same thing here. For the lessee, they have a lease equipment and lease obligation. The lease equipment is the fair market value. So $1,020,000, same amount here. And then they're doing their first payment on January 1st. So their first minimum lease payment is on January 1st, 2015. So they're gonna reduce their lease obligation and pay cash of the 200,617. There's no interest expense here because a year hasn't passed, so they haven't earned any interest on their lease obligation. Then prepare the lease related journal entries on December 31st, 2015 for both the lessor and lessee. For the lessor, they're gonna recognize their lease revenue. So unearned lease rental revenue of the amount, the 200,000, and then lease rental revenue of the same amount. They're also going to depreciate the asset because they still have the asset in their books. They didn't, since it's operating lease, they didn't sell it. So, and they didn't remove it from their books. It's still there, so they still have to depreciate it. So depreciation expense and accumulated depreciation equipment. So for them, their book value of the asset was $846,000, and the useful life is 9 years. So it's going to be $94,000. For the lessee, they're going to depreciate it too. I'm going to do first amortization schedule. Is that right? So you're going to have Jan 1st, 2015, then your payment on Jan 1st, 2015 again, then your Jan 1st, 2016. That's all we need. So your MLP, interest, percent reduction, and your book value of obligation. So your book value of the obligation, what we recorded on January 1st, was $1,020,000. On January 1st, 2015, what we did, we paid the minimum lease payment of $200,617, and no interest because a year hasn't passed. And that reduced our book value of our obligation by the minimum lease payment amount. On December 31st, 2016, a year has passed. So we're gonna have to recognize our interest, but the lessee doesn't pay it yet. They're gonna pay it on Jan 1st with the payment for the minimum lease payment. So what I'm gonna do, I'm gonna calculate the amount on January 1st, 2016, and whatever amount of interest I find here, I'm gonna put it as the payable on December 31st, And then I'm going to reduce the payable on January 1st and pay it to the lessor. So our minimum lease payment is the same here. Our interest is calculated on the book value. So on the $819 times our interest rate. Our reduction is basically the $200,000 minus the 122. So $77,000 is going to come and reduce our obligation on January 1st. Now we're looking at December 31st, 2015. So you record your depreciation and your accumulated depreciation equipment. So the amount that we're going to put here, we're going to find our lease equipment that we recorded in our assets divided by the lease term. Oh, sorry. It's the lease equipment amount minus your guaranteed residual amount. So minus $160,000. So your depreciation expense is going to be $122,000. And then you're also going to record your interest expense. And your interest payable of $122,000. And then the question 5, I think it's on Jan 1st, 2016. Yeah. So same, the entries to the lessor, they're going to have their cash and they're going to have their unearned lease rental revenue of the minimum lease payment. So the same thing as last year. And then for the lessee, they're gonna have their interest payable. They're gonna have their reduction in the obligation and their payment. So interest payable is what we recorded at year end. The obligation is our reduction here of $77,000. Then our cash should equal to the minimum lease payment. Yay, it did. So for question 6, assume that the fair market value of the stripper returned by mail on December 31st, 2022 is $138,000. Prepare the journal entry to record this transaction in the accounting books of the lessee. So what's happening here is, one, you want to get rid of the asset and accumulated depreciation in your books. And if your guaranteed residual value is bigger than the fair market value at the end of the year, the lease, then that creates a loss for the difference. Same thing, if your guaranteed residual value is smaller than your fair market, then it's going to be a gain. So first, we're going to get rid of our assets in the book. So your accumulated depreciation equipment, it's your depreciation times 7. Then your lease obligation. We're going to plug it at the end, but you can also find it here by doing the 7 years. It's going to be your balance at the end here. I'm just going to plug it because I'm feeling lazy. Then you have your lease equipment for the amount that we recorded in the books on January 1st, 2015 of $1,020,000. So here your lease obligation is going to be reduced by $160,000. Now we're going to calculate our loss. So our loss on lease equipment is our $160,000 minus the $138,000, which is the fair market values that they put in the question. And you're going to have to pay cash to the lessor. For requirement 7, regardless of your answer to question 1 above, assume for this question only that this lease had been classified as a sales type lease by Bell. Prepare the entry to record the lease transaction in the books of Bell on January 1st, 2015. So this is the same transaction as we did for question 1. So we're going to have our lease payments receivable / your bill that you might see in your books. This is going to be your lease payments receivable. Hold on, I went blank. Oh, this is going to be your minimum lease payment of $617 times 7, plus your guaranteed residual value. And your COGS is your book value of $846,000. Then you have your sale of $1,020,000. You have your inventory, same amount as your COGS, and then your unearned interest, which you can plug, or you can do basically your lease payments receivable minus your sales. I guess you're plugging it up again. So you're going to have unearned interest of $5,404. For your COGS, again, what you can do also, you can reduce it by your guaranteed residual value, PV it. So basically it would be PV of 15%, 7, no payments. Your future value is 160,000. And type is beginning of the period. So this, your COGS could be 846,000 minus your 60,000, and your sale could be 1,020,000 minus your 60,000. So 959,000. So either this amount and this amount, or this amount, both are good. And it doesn't change your lease payments receivable or your unearned interest. So that's it for tonight. That's it. We've done it all for